right, good morning, ladies and gentlemen. Today is October 25th, 2023. 10/25/23, and I'm back with another edition of the Wednesday live show, and a lot of excitement going on everywhere. Interestingly enough, today, this morning, if you've been watching the market, as soon as they rang the opening bell, the market started dropping significantly, and well, it seems like significantly. I mean, we're down about 1% on the S&P. It's kind of interesting because overnight the market was just kind of floating along sideways, and then, man, as soon as they rang the opening bell, the sellers came right in. So that was kind of interesting because, as we'll see in a minute, the market kind of looked like it was going to try to rebound a little bit, but anyway, there's, lots of crazy stuff going on. There's the war in the Middle East. Tensions look like they're escalating. You got all this House Speaker nonsense going on, and more importantly, the market seems to be trading based off of interest rates, right? And so the correlation, like over the years, I've seen all sorts of correlations that were basically the prevailing narrative at the time is that one thing's correlated with another. Well, it just so happens that we're right smack in like a correlation where every uptick in interest rates, the market goes down, right? And so it's kind of interesting because like I said, over the years, there's been lots of times where the market, I mean, obviously interest rates mattered, but they weren't the sort of trading tick for tick. And so the other weird thing right now is that the VIX seems to be completely detached from what's happening with the actual market, which is kind of unusual. But I remember years ago, many years ago, other times where the VIX like wasn't really reflecting what was happening in the stock market. The market be going down and the VIX wasn't up very much and that type of thing. And I think we had a day recently where both the VIX and the market were down and so or up. So anyway, the correlations are, what I guess you would call transitory, a lot of them. So, but right now, it's just a weird sort of period in time because the market itself is basically like 90 something percent correlated with the movement in interest rates. So, real quick, let's take a look at the S&P here. A couple of different views. What's interesting, I'll tell you what's really interesting is those of you that have been watching for a while know that I drew like this support and resistance zones long months ago. Long time ago, months ago, maybe, well, I don't know, August, September, or something like that. It sort of made sense. But here's what's uncanny about this. I haven't changed any of this, and since I drew them, basically. And so this support zone, I basically drew this based on, you see this little sort of pattern here back in May. I guess it was late April, early May, where this one little sort of, I guess you'd call that a gravestone doji or whatever. I mean, if it was a candlestick chart. But anyway, I looked at this little pattern here, and of course I'll zoom this out here in a minute, but I drew the bottom of this support zone based on that high right there. And of course I drew the high part of the support zone based on, this breakout right here, based on the highs of these two bars. And so that's why, that's where I got the actual zone from. And so what I find most interesting about it is 2 days ago on Monday, the low of the day, right? And there's the 200-day moving average too, right there. The low of the day, like literally bottom ticked the bottom of this support zone. So, and then of course, the market kind of bounced, and then yesterday we had this day where it sort of gapped up and rallied, and it felt to me, or it seemed to me, like like everybody, sort of turned bullish really quickly and thought, okay, well the sell-off's over. And quite frankly, I mean, look at the down move that happened here over these 5 days. I mean, market went from almost 4,400 straight down to 4,200 in just 5 days, and so it sort of kind of felt like there would be a relief rally. It was extremely oversold, but now we're in the thick of earnings season, and so Microsoft and Google released earnings last night, and Microsoft up big and Google down big. So they kind of offset each other. But it was today's kind of interesting because a little bit of a gap down and then follow through, and so we're back in that sort of support zone. And today's entire price bar is under the 200-day moving average. So we kind of poked below it and tested it, bounced back above it, and I think yesterday might have been a pretty big fake out for a lot of people, because I think it was yesterday that Bill Ackman came out and said that he covered his bond shorts or whatever, and so it seems like yesterday almost was like a little bit of a bull trap, so far. I mean, but market sure acting a little weak today, so it doesn't. I guess there's the old term turnaround Tuesday, and so I guess that's what yesterday was. But things are looking a little dicey today, and so keep an eye on the bottom of that support zone here. Let me zoom out on this chart a bit just so we can get to sort of the bigger picture. First of all, I want to go all the way back to where that trend line starts from. There we go. So, the October lows in 2022 is where this trend line starts from, and it's drawn across the lows. And right here, like right in this area, this particular day, it was kind of interesting because the market had sold down literally to that trend line. I mean, it doesn't get any more perfect than that. Sold down to the trend line in the top of the resistance zone, and it bounced a little bit, and then it came down here and sort of hem-hawed around really close to the 200-day, and then got a fairly significant bounce, which took it right up to, and it practically kissed the 50-day moving average on that bounce, and then got turned back. And so I don't put a whole lot into the 50-day and the 200-day and all that good stuff. You can see, I talked about this last time I was on, where you had all these like vacillations above and below the 200-day, and there's lots of times where the market will break below the 200-day, spend a little bit of time there, and then just pop right above it. But in theory, a lot of people watch the 200-day and always have, and the same with the 50-day. So sometimes the market does react at those moving averages, just sort of based on, I guess, algos that are programmed to react around those moving averages. But anyway, it's looking a little dicey here, interestingly enough. Every bounce, it seems like people get really optimistic. So here's the thing is, the fourth quarter, and especially November and December, seasonally really strong, right? So I see all kinds of statistics, and most years, interestingly enough, the small caps theoretically, well, I wouldn't say theoretically, historically, the small caps are kind of strong in the fourth quarter and towards the end of the year, which brings me to IWM. Let me find it in my list here, because man, the Russell 2000 is really, really sketchy looking, right? So the October lows. Interestingly enough, the Russell had actually made, there's the October 2022 low, where like the market, in quotes, made its low, S&P 3500. But back here, the Russell had already sort of tanked. And then, I mean, look at this pattern crazy. So, there's the resistance zone that I had drawn. And interestingly enough, I never did draw. I guess I should draw a support zone here. But at this point in time, it kind of makes sense to, and I'm not sure if let me zoom out a little bit and see how that looks as far as accuracy. I don't like it to be. So there we go. Let's quite frankly, last time I was on, I had a trend line drawn. Let's put that support zone like right about there. That looks pretty good. Yeah, extend it out a little bit. So I'm trying to see what that looks like if I zoom in. Whoop, I got to save this chart first. um, yeah, what I'm shooting for here is, that low right there, and obviously the October low, and then, kind of this congestion area. That's close enough for government work, but anyway, yeah, that's crazy because we'll zoom way back out here. We'll zoom out to, where is it? Oh yeah, the pandemic. This is what I wanted to do, is look at this. And of course, nothing's ever going to be perfect to the tick, but there we go. That's what I was looking for. So now I got to save this again. All right. Wow. Russell 2000 is in a really, really interesting spot because there's the pre-pandemic highs, right? And then of course, there's the pandemic that'll go down in the history books. The S&P 500 lost 35% in like 4 or 5 weeks. So percentage wise, I mean, I don't know. I can't figure out what the actual Russell 2000 ticker symbol is in stock charts. I've searched and searched and looked around, and it's not $RUT. So I can't even figure out how to look at the actual Russell 2000. Maybe I'll try again, but anyway, I spent some time doing that recently and then gave up and decided to just go with IWM. But anyway, this is extremely, extremely precarious, and obviously the Russell doesn't look anything like the other major indexes. So, Russell 2000 is chock full of biotechs and regional banks. Is I think I read that. So, but anyway, keep your eye on this. I mean, it's coming into some major, major support. It's interesting because we've talked about how 2021 was like this big, gigantic sort of, just this big, gigantic sort of up and down zigzag sideways for a year, maybe longer, and then of course there was the false breakout. But anyway, so it's doing the same thing right now. It's a big, gigantic up and down zigzag, and it's going to be really super interesting to see what happens now that it's down, near major, major support. And so, there's lots of stocks like regional banks and different stocks that if you zoom out to the pandemic, it's always interesting to see where the price is now in relation to the pandemic highs, because there's tons of stocks that are still above it, obviously way above it, and there's also lots of names that are actually below what the high was before the pandemic. So that was kind of a and the reason that that's useful is because the pandemic obviously was sort of I don't even know what to call it. It's a chapter in the history books. It was a big deal, right? It was a really big deal because of everything that's happened since the pandemic broke out in China and everything that happened here. It kind of changed the course of history, so to speak. And so anyway, to me, it's useful when looking at charts to zoom out to that. So I spent a lot of time recently looking at weekly and monthly charts too, but anyway, this is something to keep an eye on, how the Russell does, and how it it reacts as it comes down into this support. I mean, it's literally right there. So maybe we'll see some chopping around and we'll see another, maybe we'll see an end of the year rally. Geez, I don't know. It's hard to know because there's so much in the mix now. And see, one of the things, before I forget, let's look at this TLT, right? Because this is the big deal here, right? This is the ETF where everyone's trying to sort of catch the bottom. Well, hang on, let me switch this to a weekly chart. I think that would make more sense. So there you go. Um, I saw something recently that said, you know, all the money that I've made in the stock market, all the money that I've made in the stock market happened, as interest rates were falling, which is kind of an interesting quote because the fact of the matter is that interest rates were in basically falling for most of a generation. I think of a generation as like 50 years or something, but I don't think it's that much. I think it's like 20. But anyway, as long as most of us have been in this business, interest rates have been coming down with a few little blips along the way with the Fed raising rates here and there. But anyway, this is I think I saw another statistic that said something like, the 60-40 portfolio, 60% stocks, 40% bonds, just had the worst 2-year period in 100 years or something crazy like that. So we're definitely living in interesting times. Um, and so, interest rates, the thing of it is, there's a difference between like the day-to-day, intraday correlation between interest rates and the market, like I was talking about before. That's one thing to look at, but another thing to look at is like sort of the secular trend, right? And so, the secular trend in interest rates has been that they're going down, for as long as I can remember, and then all of a sudden, that has changed here recently since the Fed embarked on the fastest rate hike cycle in 40 years or whatever. I mean, I can't keep all these statistics straight in my head, but so, here's basically, interest rates, short-term interest rates. This is probably pretty close to whatever the Fed funds rate is, close enough for our purposes here, but let's go to monthly. I don't know how long this is. Yeah, so yeah, okay, this is pretty interesting. I didn't realize this went back that far. So, here was the inflation of the 70s, right? So look at how crazy that was. I mean, one year. I mean, this is basically interest rates, right? And so, you know, inflation of the 70s, they had to raise interest rates, all the way up there to bring inflation down. But anyway, so the important thing here, is, you go back here to the 1980s, right? And where interest rates were. And then so, like I said before, most of the money has been made in the stock market over this secular period of declining interest rates. And then this is, in my opinion anyway, there was like, two big mistakes in Fed policy, and that's consequently, that's this mistake here. This mistake, it resulted in the inflation that that anybody could have seen coming. I mean, you can't tell me that these Fed economists didn't realize that creating trillions of dollars out of thin air and slashing interest rates to zero, which was the result of, that was their pandemic response, right? You can't tell me that they didn't realize that that would create inflation, right? I mean, I saw another statistic recently to the effect of, 40% of, the US dollars that exist were created in the last, few years. And so they basically, and even Powell, when Powell was speaking at the I guess the New York Economic Club, he said, in hindsight, they might have overreacted to the pandemic, and so anyway, them raising interest rates like this is what they're doing to try and quell inflation. But as I've said before, the inflation damage has already been done, because if the inflation rate, drops back down to 2%, if the inflation rate dropped to zero, all the prices are still going to be elevated from, we're all paying a lot more for everything than we were a few years back, right? And especially, grow food and shelter, the two most important things. And then, they never talk about health insurance, right? Or medical costs and all this kind of stuff. I mean, inflation's just insane. And so the price of a lot of stuff has, basically doubled since before the pandemic, over the last few years. And so anyway, but to me, this period back, this was the Janet Yellen Fed chair period, and they kept threatening to raise rates and threatening to raise rates, and they hem-hawed around, and they'd raise a quarter point, and then they'd hold off. And so, um, and of course, so then they finally got on this rate hike cycle, right, back here. And as you recall, like, I think it was 2018, right? So somewhere on this chart is, I have to zoom in. Yeah, so they held interest rates at zero for what, as a result of, the 2008. See, there's the 2008 crisis, right? And so they basically slashed interest rates, and then they held them low. They probably, I would say by like 2012, 2013, the crisis was pretty much over, and not to mention their balance sheet. So I'm not even going to get into that, but anyway, it's kind of just a big overview of where they screwed up. They held interest rates too low for too long. During this period here, they basically created a bubble in stocks and housing, right? Um, I mean, they would. This was the period of time where they'd be like, "Oh, there's no inflation." I mean, the Fed was literally like saying, "We need inflation." They were all worried about, like trying to get inflation higher because I guess their 2% inflation target, even though their mandate says stable prices, doesn't say 2% inflation rate. But anyway, long story short, um, they waited too long. They finally raised rates up, right? And then in 2018, right, things started to get pretty ugly, right? I guess when short-term interest rates hit a measly 2%, stock market had a down year. And so anyway, um, so they started lowering rates, based on the idea that well, quite frankly, I'm not sure why they started lowering in 2018, or yeah, 2018, I guess. The stock market was kind of tanking. I'm trying to remember, because 2018 started off as like one of the best years ever for stocks in January, and then hey JR, good to see you, man. So yeah, in 2018, I remember the headlines, best start to a year in 30 years or whatever, and that bodes well for stocks. And then, of course, 2018 turned out to be a disaster. I think the S&P was down 6%. So, yeah, JR said he remembers the 80s well. Rates were high, and so yeah, I mean, my mom tells me the same thing. The 70s and 80s, people bought homes with crazy high interest rates, some of them double digits and that. But the thing of it is that home prices were like really cheap back then. My parents bought their home in, I guess, probably sometime late 70s, mid to late 70s or something, and what they paid for it is like equivalent to what a car costs these days, right? So, I mean, with really high interest rates and low prices, it's always about, the payments or whatever. So, every time I think about mortgage rates and home prices, I visualize it as like one of those scales, right? And so Anyway, that's a whole nother story, but fact of the matter is that, these short-term interest rates and the speed at which they went up like this is, wreaking havoc everywhere else. I wanted to look at the Qs real quick, so and I guess this monthly chart's pretty interesting. I don't you have you know I'll be honest with you. I looked at monthly charts last weekend, but I haven't really looked at them in a while. And of course, this is a line chart. So let me go back to where am I at here? Let me go back to my main view here. Yeah, so we started off and talked about, this support zone, all that good stuff. So it's going to be interesting to see, what happens. We still got a lot of big earnings coming out, so I haven't really Google down, Microsoft up. We got a bunch of earnings still coming out. Nasdaq's down almost 1.5%, so that's kind of interesting. But let's go back now that I got my standard chart here. Yeah, I don't really. Somewhere I got a Nasdaq chart that is marked up, but I mean it's pretty easy to see. Pretty easy to see what's going on here. I mean, basically, and it's almost uncanny. I've been drawing these lines for well over a decade, and it still blows my mind how well they fit, right? Like you draw this trend line across these highs, and you notice that there's like 3 touches of the trend line. So obviously they're not always that perfect, but it is what it is. So there's a couple different. I've seen lots of different things drawn on this, but I think I think a support zone. I like drawing horizontal lines. Quite frankly, horizontal lines to me are more useful than trend lines. So anyway, the Nasdaq is kind of nearing a pretty important support zone here. Yes, a daily chart. And of course, you could take this line, draw a sort of parallel line. You could draw. I've seen some people draw wedges in here like this, but that's quite frankly, I mean that's a pretty good channel right there. Draw it across these couple of lows here, and it fits pretty well. It actually fits really well, like with these lows. So not exactly not exactly perpendicular, but close enough. Anyway, it's going to be interesting to see what happens here. Probably, probably, a couple of more big names come out with earnings, and that's going to determine whether this thing breaks down or not. Um, the symmetry of it sort of, coming down to this lower end here and this support, theoretically, I think a lot of participants are looking for a bounce, into the end of the year, which would line up pretty well with seasonals. But of course, there's a lot of other stuff going on too, right? And quite frankly, I mean, the Nasdaq 100, I believe, is around 30% in the newly coined term Magnificent Seven, right? That's what they're calling them now. So, it was the FANG stocks, and now it's the Magnificent Seven, because FANG kind of doesn't really. Well, it doesn't include a few of the stocks that are holding the market up, and ever since Facebook changed their name to Meta, that got all screwed up. But anyway, there's basically 7 stocks holding up the market, and I read all kinds of statistics on that, and so what's important, obviously, is what those stocks do, and I guess Apple being the big one. And the crazy thing is that, I mean, if you look at the actual, what's going on with Apple, well, geez, they've had like quarter after quarter of, declining. I mean, they're not growing like they used to. I remember when Apple's PE was like, 12, like they were a hardware company or whatever. And so, it's got a super high P. It's the most widely held widely owned, biggest market cap stock on the planet. And so, the old saying, so goes Apple, so goes the market. Speaking of which, real quick here, I got a couple Apple charts here. There we go. This is the one I was looking for. Because it's got the earnings date on here. So looks like earnings are coming out 11/2. That's pretty interesting because the Fed announcement, if I'm not mistaken, is on 11/1. So like 1 week from today, and that's something we haven't talked about yet, but I mean I could talk all day, but I try and keep these about 30 minutes. Anyway, so you got next week is going to be wild because you got the Fed announcement on Wednesday, and they keep saying data dependent and all that, and the funny thing is the data kind of indicate that the economy is a little bit stronger than it feels like, and that and so I mean it's very difficult to know, but they're either gonna be done, or they're going to hike one more quarter point and then say that they're done would be my guess. So I honestly don't know. I mean, you've had tons of really important people, and economists and these fund managers, and I mean literally everybody seems to think that the Fed is done. They're done hiking, right? I think Gundlach said that, and all sorts of, I can't even remember, but all sorts of people have said the Fed is done hiking. So anyway, next Wednesday, I guess we're going to find out. But keep this in mind too, because I started off the show talking about this crazy sort of intraday tick by tick correlation between interest rates and the market, and how they're so highly correlated now. Keep this in mind. In the past, historically speaking, when the Fed starts to cut rate, or when the Fed cuts rates, that's when the market falls. That's when and it makes sense because the Fed doesn't cut rates until the economy starts really going downhill. Like if the economy looks like it's headed for recession and slowing down too much, then the Fed starts cutting rates, right? And so everybody's hoping for the Fed to quit raising, and last year there was all these rallies based on the Fed was going to pivot, which was crazy, right? Anyway, real quick before I go back off this chart, you can see Apple's right here on the 200-day. It's had this little sell-off. You can draw a trend line across the highs, so it's likely to just sort of flounder around, maybe rally. We'll just have to see what happens when earnings come out. So I wouldn't expect any really big moves in Apple until they release the earnings there. But it's going to be a big deal when they do, just because of where it is. So hang on, what is? Oh, this was like an old resistance zone that I had drawn on it, right? Like from way back here, I had resistance up here, resistance here, and so this move in 2023 is kind of nuts, if you ask me. I mean, I quite honestly I can't tell you what that is based on. Hey Jim says he's been bearish. Yeah, I've been well, quite frankly, on the I'm kind of bearish myself right now. And part of that is all this saber rattling in the Middle East. I mean, it seems like that has the potential to escalate. So anyway, back to my, because I'm gonna have to wrap this up here in a minute. I've already got people calling me. Here we go. Here's my main chart. Real quick before I lose my train of thought here. This. There was a couple of big rallies. Heck, it might have been last year. I can't even remember, but this whole Fed pivot thing, right? I mean, there's an endless parade of Fed speakers, for 2 years that have been saying they're going to continue to raise rates until, they're certain that inflation is tamed, and and the market's and they're higher for longer and all this. And I mean, all of the Fed speakers for the past year or more, year and a half, have been telling you that they're going to continue to raise rates until inflation is tamed, and they don't want to have a resurgence in it, and the whole higher for longer. And yet the market participants just over and over would rally the market based on someone said in the Wall Street Journal that they were going to pivot or whatever. So it's kind of silly, but this short-term pattern is pretty ugly. It really is. I mean, you got, just looking at where you are now. The thing that this got going for it though, JR, and what I've talked about here, there's two different patterns happening here. Bigger term. This is like a big, gigantic sort of cup and handle, right? And so it's going to, the handle is still sort of forming here. I don't want to mess up my drawings that I go to on here, but anyway, you can kind of see a big giant cup and handle. And so in theory, a handle form over here and then way out, maybe, I mean, this is a weekly chart. And so you're looking at years here, but it's, I'm not ruling out the possibility that that there is a big rally. Now, keep in mind, based on CPI inflation, the S&P needs to be at like 5,300. Where is it? Yeah, so this high right here, 48.18, I believe. If you adjust that for inflation, the S&P needs to be at like up here at 5,300 to make an actual inflation adjusted high, which is something nobody talks about. But in theory, on this longer term chart, you got sort of a cup and handle. But what you also have is you got on this. You zoom out even further on the monthly chart, you have the same pattern as like every bubble in history, right? Every bubble in history, you get like this huge run up and then a sell off, and then you come back up and make a lower high, and then all hell breaks loose, and I'll prove it to you. This is, this is sort of, see if I go to the weekly, maybe it'll look better. Yeah, a little bit. I mean, ARK's a little bit different. We'll go to that. So, I mean, this is what the South Sea bubble looked like. Big parabolic run up. So like take something like maybe PayPal. Same sort of pattern. Square. I mean, just picking them off the top of my head. And I mean, Peloton. Think all these stocks. Think of the hype in some of these things. I mean, I can sit here and type a dozen symbols in here that are basically look just like the .com bubble, right? Where stocks just went parabolic and they sold off, and then they bounced a little bit and made a lower high, and then all the way back down like this. What was that one that came out with? Oh yeah, Snap. Like Snap came out with earnings yesterday. I mean, there's the IPO right there. This is a classic, .com bubble chart. And so we basically, it's funny because years ago, sometime over all these years, I've joked about how it's like the .com bubble all over again in some stocks, and it kind of turned out to be true. Because this is the exact same thing that happened during the .com bubble, is you'd get stocks that would IPO, and then at some point had a parabolic run up, and then collapsed, and then, I mean, look at this, right? This is what blows my mind, is how flat this thing is since it collapsed. Absolutely crazy. There was another one I was looking at. I'm trying to think of it. But anyway, so, oh yeah, like Zoom. Right? Look at Zoom here. I mean, that's about as classic of, a bubble bursting as you'd see anywhere. But anyway, the point of the matter was, back to the S&P, is that on like these long-term charts, not necessarily identical to this, but you get this huge parabolic run up, you get a big sell off, and then you get sort of that one like cycles of a bubble chart. And so you get the return to normal I guess is what you would call it, right? Go back to my chart. So everybody's seen that chart. Everybody's seen that chart. So you get this like right here it says new paradigm, right? And then you get the sell off and the fear or whatever, and then it says return to normal, and then all hell breaks loose once you take out this low. So I think you know what I'm talking about. It's like the sentiment chart of a bubble. So anyway, hey, not out of the woods by any means, but then again, you got to consider that if you look at a chart of the Venezuelan stock market, as inflation heats up, stock prices do tend to keep up with them theoretically over a super long period of time. Um, Over a super long period of time, the prices of stocks may or may not keep up with purchasing power, but they're about the closest thing that you're going to get to maintaining purchasing power. So anyway, if but hey, in the near term here, I'll be honest with you, in the very near term, there's a whole lot that could shock this market, and that's one of the things that sure, we sit back and look at the monthly chart and talk about a cup and handle, but I'll tell you this, um, all this stuff that's going on with interest rates and the debt and all that crazy stuff and valuations and banks, and I could sit here and list about a dozen things that that have the potential to, like, reasons that to be bearish, that the market shouldn't go up. And there's a lot of things. All it takes is like one. Yeah, all these countries sending all their armaments, warships, and all this stuff to the Middle East and all this. All it takes is like one accident or one thing to go wrong or whatever, and then and so I hope that nothing happens, but there's a lot of potential for that. And then this other thing about us, the debt to GDP, and of course you can look at Japan. It's like Japan is like the beta test for what's happening here, and there's all sorts of stuff I could talk about that I can't get into this week. But anyhow, in the very short term, I'll tell you what, I'd be really super nervous about just being complacent at this point. So you definitely won't be hedged or short or whatever. It depends what you're trading, but it just really doesn't feel like the time to me to be like buying. There's almost no reason to, and especially if you look at the whole market, and it's just a handful of stocks holding it up, so to speak. Last thing I'll look at, and then take this up next week. So look at the equal weight S&P 500, right? It looks pretty dicey. It's the equal weight S&P 500. Geez, it's down on the year, right? So this is something that just shows how the magnificent seven stocks are sort of holding the market up and under the surface. And so it's not like the good old days where you find there's all these growth stocks and all these different stocks you can look at, and you find the patterns and be like, hey, buy this here and it's going to rally in that. It's been a really, really sort of tough environment, and quite frankly, this chart right here proves it. So there's the beginning of the year, and sure, we've had lots of ups and downs. We had this big summer rally, but look where we are now, and you don't need me to tell you that that there's a lot of potential black swans out there floating around. And so the best thing this market's got going for it right now, I guess, is seasonality. So sometimes it's hard for me to imagine that stocks don't rally around Thanksgiving, because it seems like they almost always do. So and there's some bullish statistics out there, but I think quite frankly, if somebody had a bunch of money and came to me right now and said, hey, is now a good time to put it in the stock market, I would say no. I would say hold off. Just the worst thing that can happen is, the market starts to rally. You have to, in order to be a buyer right now, let me just go back to the S. In order to be a buyer right now, you have to, there's only one reason you would want to buy now, is that you think that you're going to miss the boat because you'll never get a chance to buy at 4,200 again, right? Think about that. So if somebody came to me and said, hey, I got a whole bunch of money I need to put to work, I'd be like, well, is 4,200 a generational buying opportunity? I would say, that you'd be better off waiting for, the market to break back up over 4,300 than you would be to buy here. Like, let it prove itself. Quite frankly, until the market gets over this trend line right here, or even if I drew, a steeper trend line, the market can't go back to, new highs. It can't, have a big rally, and you're not going to miss out. There's all sorts of levels here. I could put, and quite frankly, moving that to there kind of makes sense too, because that's another humongous resistance level right there. So I may just move that and save it. But anyways, oh jeez, these stock charts, they drive me crazy. So I'm gonna have to extend that out here a little bit. I'll tell you what else is really interesting is that this upper trend line here. There we go. This upper trend line here prior to, okay, so hang on, I gotta save this because hopefully it won't save a duplicate copy of it. But anyhow, I'm losing my train of thought because the stock chart is such a pain in the rear these days. Anyway, yeah, this trend line here, I mean, if the market was going to rally and, go on to make new highs and end of the year, there we go, end of the year rally and all that, that trend line's coming down pretty quick. And so, there's a lot of overhead resistance. My guess is it seems like if I was going to put odds on it, there's a lot more odds that you'll get a chance to buy lower than like missing the boat is, I guess, my point. So there's so much going on right now and so much potential for this and that. And so, it's the old FOMO thing, fear of missing out. I don't think it feels like a time where you want to have fear of missing out. And so, hey, I could be wrong. At the end of the year, it could have been like, oh, 4,200 was a generational buying opportunity. But like I said, I think you'd be better off. Just waiting and seeing what happens. Just to make sure that something doesn't come out of the blue and really tank this market. And there's a lot of things that could. So the first thing, is the Fed meeting a week from today, and then the next thing is Apple's earnings, right? So those are the two biggies, and they're going to happen next week. So anyway, I'm going to wrap this up, and I will see you back here, same time, same place next week.